Well, if you're a bond buyer, I don't have to tell you, it's been a good decade for bonds, past decade. Everybody, though, in the stock market, I got to tell you, bond folks, they hate bonds. They hate them. But if it is going to be now they're always looking for the decade of the stock, right? If it is the decade of the stock, what are some stocks that even a bond lover could love? Jack Hough from Smart Money is going to tell you. Tell me, because I got to tell you, I hate stocks.
You hate stocks?
I have not been in the stock market since 07.
What do you like?
Sure, and it's only my 401k. I've been in bonds. I've been in government bonds since 07.
Here's the problem with bonds.
Ease me into it. Ease me back into the world of stocks.
You're clearly a genius, first of all, because you've done very well in your bonds up until now.
Right.
But let's look ahead in the future. You make money in two ways on your bonds. You collect the income, and then the prices rise as interest rates come down. But interest rates are so low right now, you don't have much to look forward to in terms of capital appreciation. The rates on the bonds are very low, especially top quality corporate bonds are being treated like sovereign bonds right now. You're getting nothing on the yields. So the normal state of affairs throughout history is for investors to get more on corporate bonds than they get on stock dividend yields, all things held equal, if we're talking about the same companies. And the reason is because corporate bond yields are fixed, right? What you see is what you get, whereas your dividends grow over time. So you can start off with a smaller dividend yield and make more money as you go along. Right now, the opposite is true for many top quality companies in America. Companies like Proctor Gamble, like Coca-Cola, like Chevron.
Like Chevron. Let's talk about Chevron for a second.
So well, I took a look around companies that have bond ratings of AA or higher, meaning very low credit risk or minimal credit risk, according to Moody's. And I compared their intermediate term bonds with their dividend yields, and I looked for ones that had larger dividend yields than their bond yields. And those were two of the names that came up. United Parcel Service was on the list. Johnson & Johnson was on the list. So now, of course, if you're a bond investor, you get your money back at the end of the term, right? And you don't get that with stocks. You worry about...
Maybe you do, maybe you don't. That's part of it, the whole thing, right?
Yeah, but using Procter & Gamble as an example, their last dividend increase was 7% dividend increase this year. They've increased dividends each year for more than 50 years. If you own that stock over the next 13 years and they're able to grow that dividend 5% a year, you're going to get enough in dividends to pay you back for the share price. It's not quite the same as getting your principal back on a bond, but the point here is the longer you're in a stock with a reliable dividend, the greater degree of certainty you have of your money coming back to you.
You talked in the beginning about how, and you talk about this in your column today too, about how the capital markets have changed, sort of in a sort of fundamental way, at least as long as the Fed's going to keep things at zero. Is this sort of encouraging people to get into some of these stocks? I mean, if you're looking for safety, money back, that whole thing, does this maybe encourage you to move into stocks?
Well, it has to. I think people have been so risk averse that the prices on these bonds are so high. That's where you're seeing these yields of 1%, 2% and change. And stocks are at their historic average valuation, about 14 times trailing earnings. By the way, it's not that stocks are a screaming bargain right now, and it's not that these dividend yields are so gigantic. We're talking about yields in the 3 to 3.5% range. But it's just that relative to bonds, stocks look ordinarily priced and bonds look very expensive. So if you're someone who's an income investor right now, I think you have to look ahead over the next decade and you have to say, look, which of these is poised to do better? Companies are sitting on heaps of cash. They're under a lot of pressure to return that cash to shareholders. Investors are desperate for yield. Therefore, I see some dividend growth coming in years to come. I think you're going to be better off with those shares.
Yeah, I mean, and unfortunately we have to cut this off. The real issue seems to be that if you're buying bonds, you're looking for your return on your principal. You're looking for a little cash. You don't care that the yield is low. But then you have to look at what the Fed's doing, and the Fed's going to keep rates low for so long. At some point, that calculation starts to change your mind, I think.
I think so. I think right now the odds favor shareholders, but we'll see.
We will see. Jack Hough, thank you very much for coming on.